Okay, well, I think we'll go ahead and get started here. I hope everybody can see the screen here. Just make sure I know what I'm doing. It's been a while since we've done this. There we go. So just some formalities there. Of course, many of you know I am an attorney also, but my main job is managing assets for these clients of ours who are mostly retired, and something I've been doing for 22 years, 24 years now, pretty much ever since I left Oglethorpe. And that was the reason that I went to law school, was to work on trusts and estates. So I just saw one of my law school professors, two of my law school professors, on Friday night at a charity event. So that was really pretty cool. And I see that one of my Oglethorpe professors is attending here, Dr. Shropshire. So it's great to see you. Hope you're doing well. Ted, I hope you're doing well. Mary, I know you're doing well. Jim, good to see you. John, good to see you. Blair, good to see you. Al, as always, good to see you. So you guys all know these disclosures here, and more people are joining as we go here, so they're not going to be missing much. So today's agenda, we're going to be talking about basically what happened in 2021. It seems like ancient history now. What drove the market performance in 2021, and where we are today. And then, of course, we have some financial experts that always want to give us their 2 cents, and some of them are right on the money. So we'll take a look at that too. And of course, we'll talk about some of the other things that have kind of popped up since then. But if we look back at 2021 in terms of stock performance, it ended the year pretty good. We had a lot of ups and downs along the way. We had the inauguration, and then we had all that fallout from that, and then we had a $1 trillion COVID bill, and then we had we had inflation moved to rises to 4.2% in April. And then we got some Delta cases that surge, and then the Delta variant, then we had that sort of drop there, and then more vaccines happening, then the Omicron variant. And then, at the end of the year, we ended up pretty high. But if we look at, what happened since then this is really the last 12 months. And you can see it's been basically a lost 12 months, of what we call a stressful round trip, where people watch their accounts go up, and then they watch them drop. So you can see you had almost 11 months, 11 months, 10 months of growth, and then 2 months of pretty dramatic drop off there. And we're going to talk about what happened and what caused that, and then what we can kind of see going on in the future. One of the most important things, and probably the most important thing that we look at when we are talking about stock performance, of course, are corporate earnings. And we can see that corporate earnings have continued to do well. Obviously, this was the pandemic, and then the economy shut down there. But since then, the corporate earnings are sort of back in play. And that's 70% of our driver in terms of stock prices, which is consumption, consumption by our consumers, which we are a fantastic consumer economy. We were taught very well. So if we look at the economy over the 4 quarters of last year, we can see that there weren't a whole lot of changes, except for maybe inflation there doubled. And we can see that inflation reared its head there starting in the second quarter, and it's been pretty consistent for the rest of the year. The other thing that happened that was sort of, I guess, a little alarming would have been consumer sentiment. Because again, consumer sentiment is a large part of our economy, at least consumer spending. And when consumers don't feel so good, they don't spend as much. So we can see that that's dropped off considerably there from the second to the fourth quarter. But of course, that was an estimate at that point. It takes about 3 months to get all this data compiled and get it together and get it out there in the mainstream. So we're running 2 or 3 months behind. Now, if we go back and see what happened and where we were kind of at the end of 2020, when we had the pandemic in 2020, and then the market dropped in March, and we were, by November, we had fought our way back pretty good. But you can see that there's still some problems there. Monetary policy, they were very lenient, and we had dropped interest rates back down to 0. So that was part of the quick recovery that we had. Political environment, that's always kind of negative these days. Geopolitical risk, that's always kind of negative these days. Equity market valuation, still, even in December of 2020, the equity markets were still a good bit overvalued, and inflation had started at that point. About a year later, in December of 2021, you know, we had recovered a good bit. The economy was starting up again. Everything was starting to look good. All these green dials here mean that these are all positive for, you know, a bullish market. Again, geopolitical risk, political environment, always kind of negative. And then equity valuation. I've been saying that for a couple of years now because we know we look at the Buffett indicator and other things, we find that stocks are still very overvalued. One of the things that we do look at are leading economic indicators, and there's about 10 of those, and they're like new home sales permits, manufacturers orders, things like that, that are, you know, earlier indicators. So look at what labor's, you know, lumber sales and those kinds of things. So we can see that, you know, for going into the year 2020, we were still very bullish in terms of our leading indicators. But as you can imagine, that's probably changed a little bit now. Several of the things that we look at in terms of headwinds, you know, obviously was COVID. I mean, that was, you know, one of a sort of a black swan that came out of nowhere. You know, we didn't expect that since the Spanish flu of 1910, 1911, 1919, World War I era. And then we have, you know, these Omicron Delta variants. We seemed like we were always getting new variants, and that was always a scary thing because you didn't know what the new variant was going to do. And that was concerning. Inflation, rising yields, and those are two different things, but inflation is certainly a problem. I'm going to talk more about that, but rising yields as well. Rising yields is sort of the same thing as saying falling bond prices, because yields weren't rising in and of themselves. What you had was you had bond prices that were falling. And I think that was really a sense of, well, basically when you have interest rates that are going up and you can kind of see interest rates are going to be rising, you don't really want to be holding bonds, and longer term bonds especially, because they're almost guaranteed to drop in value, and they did. Fed policy pivot, we've seen that, and basically that's where the Fed has essentially said, look, we're going to have to stop these low interest rates, and we're going to have to stop all this money printing because inflation is out of control, and it's more than you would imagine. I'm going to show you here soon. Slowing China growth. Okay, midterm elections, that's coming up. We'll see what's happening there. Geopolitical tensions, that's certainly true. In fact, we've got more political tensions than we thought when we wrote this. Tailwinds, things that have helped us along, at least in last year. You know, economic expansion, still expanding the money supply, continued monetary accommodation, interest rates were still at zero, continued corporate profits. Corporations are very healthy, consumers are healthy, not so much physically, but financially, at least, they look healthy on paper. If you can see here, this is the net worth of all the Americans put together, not corporations, just people like me and you and our worth. And you see the orange are the liabilities. You would have thought the liabilities would have gone up a good bit, but they've been pretty consistent. So good for us. I wish our government would learn from us, because, you know, we haven't gone into debt, but our government sure has. We look at the assets. The assets have steadily grown there, and then the net worth of individuals has steadily grown. Of course, this is not indexed for inflation. I suspect that if it were indexed for inflation, the assets would maybe not look as good. So this is sort of a nominal look at it, and what is it? Al, what is it? Logarithmic? It's not logarithmic or not real. So this is the nominal number. It's not the real numbers, which have been adjusted for inflation. So, you know, I don't think the Fed does that. Okay, so, but if we look at equity valuations, we can see that we're still pretty high. PE ratios, Ford Schiller PE ratio of up close to 40. We know the average is about 16 and a half, about 17. So that's what we call the mean, and a lot of you are statistical people with math degrees and backgrounds, so you know that generally things always end up back at the mean. And when you're being so far above the mean, you have more likelihood of coming down to the mean than continuing away from the mean. And I think that's pretty obvious to everybody here on this call. And of course, one of the things that we always keep up with is the Buffett indicator, which takes the earnings from the Dow Jones or the S&P, or sorry, the Wilshire 5000, takes the Wilshire 5000 and the earnings from the Wilshire 5000, and there's a ratio that Buffett does with the gross domestic product, and he comes up with, you know, a true valuation of what the market should be. And if we follow this historical trend line there, we can see that we are about 200% above what the market value should be. So Buffett indicator to us tells us, you know, danger zone, danger zone. So that's over 200%. So that's one indicator to tell us that, you know, we need to be very careful. Inflation is another indicator. Why? Well, because inflation is sort of the key to tell the Fed that, hey, you guys need to take your foot off the pedal. And you might not only just need to take your foot off the pedal, you might need to put your foot on the brake. And not only might you need to put your foot on the brake, you might need to pull the emergency brake as well. And I think that is kind of where we are headed toward the emergency brake, full braking. If we take a look at inflation, now these are the official numbers, we can see that, you know, even now, 12-month year over year, we're closer to, you know, somewhere between 6 and 8%. But again, these are the official numbers. I want to go back and show you what the old official numbers are, because we've changed the formula 3 times. We changed it in 1980, changed it again in 1990, and this is what we're working with today. So the red line is the current inflation formula that we're using, but if the blue line is the formula that we were using in 1980. Same labor bureau statistics, Bureau of Labor Statistics, same bureau, just a different formula. The reason we changed the formula, if you might imagine, is we didn't like what it was telling us. You can see it started splitting right here, and we didn't like these higher numbers. We thought this would be better, and it was, you know, and this gave the Fed a license really to print money and to expand the balance sheet, which they certainly have. And I would suggest to you that we will probably see another change in this formula. I would bet on it, because this formula is not showing what we want it to show, and it's showing high inflation. We don't want that. But if you look at M3, which is all the money, dollars in your pocket, dollars in your bank, you know, all that stuff, we are off the charts. So in the last 10 years, roughly, maybe 12, in the last 10, 12 years, we've created 14 trillion with a T, dollars of new money. So that's inevitable. It's inevitable that you're going to have inflation. And they never say that, hey, we're just going to create some new money here. What they always do is they say, hey, we're going to have stimulus, or we're going to buy some bonds. What do they buy? Treasuries. Well, when you buy those treasuries, where are you going to get the money to buy them? Oh, we don't ask that question, because really what we're doing is we're just making that money up. But when they make that money up, it's pulling the value of your money right out of your pocket. I mean, it's the most insidious type of theft I've ever seen or known of. It's just amazing. But we go along with it, and there it is. So when they say buying bonds, they're buying bonds what they might just money that's just created. When they say stimulus, that means new money that's just created. When they say expanding the balance sheet, that's essentially buying bonds, which is with money that's just created. Quantitative easing, same thing, just money that's just created. And that's the only tool that they have. We're just going to lower interest rates, which creates more money, and we're just going to pump more money in, which just creates more money. And all of those things cause inflation. And Congress is doing the one thing that they shouldn't do, and that's spend more money. And that's money that's not even created yet, and they're already spending it. So I don't know where this is going to end, but I've seen this story before, and it does not end well. If we go back and take a look at lumber, and I think Dr. Shropshire would appreciate this, because the first thing I have here is supply and demand, right? And that's one of the first things we learned in econ. And when I was a freshman, I was only 18 years old. And it really made a lot of sense to me, supply and demand. You have a demand for things, and then there's only so much of that. And if it's unlimited, the price goes way down. But if it's very limited, then the price goes up, because people are demanding more. And people are all over with their demand curve. So some people really, really demand things, and some people really don't care about things, but demand other things. And so that's why economy is so functional. That's why it's so dynamic, and that's why it's so wonderful. And that's why it's impossible to control, and it's impossible to plan, because it's like Ludwig von Mises said, it's billions of people making billions of actions every single minute. And no one, not even a quantum computer can get their brain around that. So that's why economics is so fascinating, and yet can be so misleading. But if we take a look at the price of lumber back a couple of years ago, you can see it really spiked there. And I guess that was during the pandemic, and we had some supply chain disruption. So when I say that we have inflation is causing these high prices, or people will say that, you got to understand there's no one thing. There's a multiple of things. Certainly the pandemic created supply chain disruptions. That was certainly a part of it. The price of oil has certainly been a part of it. Everybody should know by now that when you buy something, everything that you buy in the store or from Amazon or wherever comes on a truck. It comes on a truck. It comes here from overseas, usually by some sort of freight. And then when it gets to Savannah or Brunswick or Los Angeles or wherever, Jacksonville, they take it off and they put it on a truck or a train, and then eventually it gets put on a truck. So the price of oil certainly affects that. The overall price, purchasing power of the currency. That's where inflation comes in. When you print more of a thing, each individual thing is worth less. We all know that just commonsensically, but I don't know why. I guess they do understand. There's just nothing they can do because they make these promises, Congress does, to get in power. Once they're in power, re-election comes up, so they've got to hurry up and do some promise fixing, and then when they do that, they've got to spend money, but they don't have the money to spend it, and they don't want to raise taxes because taxes are already too high. So you know the cycle. And then we have these international currency fluctuations that certainly can be part of it. For instance, we buy lumber from Brazil. The fluctuation between the Brazilian real and the dollar is up and down somewhere between $4 to $6. So, sorry, 4 reals to 6 reais in Portuguese. So we definitely have international currency fluctuations, but for the most part, it's supply and demand. With the supply chain disruptions we've had, the price of oil has certainly been a part of it, but inflation, if you go to the grocery store, that is a large part of it is simply inflation. And when you printed $12 trillion in the last 10 years, you can imagine that was more than double of our existing money supply. So not very smart, Fed, not very smart. If we look at unemployment, then obviously there was a big spike when we had the pandemic and the COVID shutdown, but that has retreated quite dramatically. But again, where do we get these numbers? We get them from the Bureau of Labor Statistics. And if we go back again to the numbers that we used to use back in the 80s, we can see, because we used to use, well, today you work part-time jobs, we don't count those. People who are have been looking for a job for a year, but now they're out of the workforce and they've just given up. We don't count those people. So the calculations are very different. And if you have to really dig in and see, well, what is your definition of an unemployed person? And it's not what you think. Someone who's been unemployed for more than a year, they're not unemployed anymore. They're just, I don't know what the term they use, like just, like suicidal or something. But it's not what you think. So if we go back to the old formula that we used to use, then our unemployment rate is much higher. You can see it's almost 35%. Well, now we'd be down to 25%. So it's a quarter of the workforce is on, and this is not accounting the people who are retired. These are people who are part of the workforce, should be in the workforce, but they're not. So 1 out of 4 are not in the workforce being productive. And so we'll have to see where that goes. Obviously, there's a lot of unemployment checks going out still. Also, every year we ask these big firms to get together and tell us what they think the S&P is going to end up with. So we're forecasting basically what's going to happen this year. And of course, this is, all things being equal, starting out January 1st. So a lot of things happen within the year that you don't know about and you don't expect. And, we've seen that. But on the group average, they're looking at, they averaged about 4,800. And if we look at where we kind of peaked out at the end of the year or the beginning of this year, it was about 4,800. So we're down to about 4,400 now on the S&P. And every day is a different day. We're about flat today. Some things are down, but the NASDAQ is way overbought like it was in the 1990s. And so we believe, and if you read my last letter, that's what we're thinking is we're thinking that there'll be a significant drop in the NASDAQ and that'll bring the rest of the markets down too. But of course, there's one thing I haven't mentioned, and I think you probably know what it is. If we had a class yesterday, we missed you guys. We had almost a full group. And we had a lot of fun. I gave out a bunch of books as as prizes, so I can't give those to you today, but I have one for you here if you want to come in and get it. It's called Economics in One Lesson by Henry Hazlitt. Great author and very simple to understand economics, basic economics. But we need to send those to the Fed, and we need to send those to Congress, because every member of Congress needs a lesson on economics. They certainly don't seem to be getting it. So what is the big elephant in the room? Well, as you might guess, that's this Russian-Ukraine thing. And it's kind of, I don't know, we're into the second month of it now, 60 days of this so far. And it's just been tragic to watch. I mean, the Ukrainians have really been through it. I mean, it's just been wholesale bombing of civilian locations. And you've got barricades in the middle of the street and dead people just lying in the middle of the street, and people just walking by like it's just, normal. So if you just can imagine that was your neighborhood, and these guys here, I hope they're taking a nap. I believe they're taking a nap, but then they're just completely tired. So if we look at what kind of happened, this was in March. I guess it was about March, so when it first started, about a couple weeks into it. A lot of what he was looking for was a blitzkrieg attack over in Kiev region to take the capital city, and hopefully the whole rest of the country would capitulate. But that is not what happened, and it has been an incredible fight, and they have done a wonderful job in fighting the Russians off, and they have now sort of focused their efforts there over on this Donbass region here, which is probably where they're going to try to settle in. And I don't know if they're just doing genocidal cleaning or what they're doing here, but it's just absolutely horrible. And there's really, I don't know, from his perspective, there's really no reason for it. But they've moved out of the Kiev region over here, and that's given people over in the western Ukraine time to sort of collect their things and bury their dead and take a minute to reflect and move on, try to get some sense of life. But this has certainly exacerbated the market. So when we see what happened, over the last 12 months, we had a pretty strong run there, and then at the beginning of the year, market just started sliding. And the Ukrainian invasion didn't really occur till February 24th, so the market had already started to slide. And we have to ask ourselves, well, why is that? Well, I remember what it was, and I don't know, maybe the Ukrainian thing popped up. We kind of went right from COVID right into Ukraine. So what really happened was Jerome Powell is signaling that we're going to have to raise these interest rates, and so interest rates are coming. And since then, he's even been a little bit more hawkish and said that, look, we're going to start off with these 25 basis rate hikes, but if that's not enough, we are not going to hesitate from raising rates a whole half a point. And I think we're going to see that. I'm pretty sure that's going to be interesting, because they normally do not do that. So there's our quarter point rate hike right there. Just occurred, and you can see that we had a run up in rates right there. We got almost a 2.5%, and then a pandemic occurred, and of course all back down to zero. So anytime we have another market shakeup, we have to drop rates. So we've got to get off the bottom, because if we don't get off the bottom, we're going to have nowhere to go when the market drops again. But ironically, it's going to be this raising of rates that's probably going to drop our market. Historically, that's the case. So let me show you historically, going back all the way to 1955. I don't know if you can see these gray lines that are running vertically. The gray lines are essentially recessions, and not every market crash qualifies as a recession. You have to have, I think it's 20 months of negative GDP for a recession to qualify for a gray line here. But if you can see what happens, we have interest rates that go up, and then we have interest rates that drop way back down, and then they go up again and they drop way back down. And then right in the middle of that is a gray line. Well, that gray line indicates, again, a recession. But for you and I, it's a market downturn, or a crash, if you want to call it that. So we're raising rates, market crashes, and then we have to reverse it. Raise rates, market crashes, then we have to reverse it. That's the only reason that you can explain these sharp reversals, because if they had the right rate, they wouldn't need to reverse it so sharply. And that's sort of prima facie. In March, about a month ago, Jerome Powell came out in the minutes and said that, look, hey, since 1955, we've had a lot of what we call hard landings, which is where the market crashed. But what we're looking for are soft landings. And soft landings, he pointed out, were right here in 1966 and right here in 1994. And 1966, 1967, the market was down 19%. And then a couple years later, it was down another 17%, the Dow Jones was. So I'm not going to count that as a soft landing, but I will give him 1994, 1995 was relatively soft because the market was not gangbusters, but it didn't crash. But in every other instance, it did crash. So out of 10 instances, there's maybe 2 that we didn't have a major crash, and only 1 that really I would consider a soft landing. So I'm not necessarily going to count on their ability to do that. You know, I've always thought that interest rates should be market driven and not human driven. And I'm sure that others will agree with me. But in any event, if we go back and we look at the Wilshire 5000, which is this top chart, and we compare that to the federal funds rate, which is the bottom chart, way back here, because the numbers are so much smaller, it's hard to see. But those gray lines, they were big market drops right there. I mean, this is in 1987, I believe, but you can see every time we had a rate hike, then all of a sudden there's a gray line. But we can focus in a little bit better here. We can see in 1999, 1998, we were raising rates, and that caused the dot-com bust. And then again, the 2006, 2007, that caused that bust. And so then here we go again. And it's been a big run, but we've also created a lot of money. So, you know, don't think that this is real growth. It's not all real. It's a lot of it is nominal, which is just, you know, more money. So more money sloshing around makes everything worth more, or at least cost more. So, so that's a big problem that we have with inflation, is that now, yes, we have had this big run up in the stock market, and a lot of us have benefited from that, but now we're paying the price. And the thing that upsets me the most about all this is, you know, we all have portfolios that can benefit from stock market runs, but, you know, the average person on the street, poor people, people that are on Social Security, people who are on just plain retirement, that don't have other assets that they can lean back on, and a lot of people in the lower middle class, and this is killing the middle class. And my heart just goes out to everybody. I mean, not as much as the people in Ukraine, but, you know, people who are really struggling to feed their families, and with children, and you know, with healthcare expenses and costs. It's just devastating to lower income people and people on fixed incomes. And I can't say enough about that. But again, you know, part of the Kool-Aid that I'm supposed to talk about is, you know, you stay invested. You got to stay invested. And if you stay invested, then, you know, over a period of time, you're going to do well in the market. That's not necessarily our philosophy. Our philosophy is, look, if we know the market's going to drop, we have a really good feeling about it. We need to get conservative. That doesn't mean get out, it just means get conservative. And that gives us an opportunity to buy in when the market drops. Because here's one thing I've learned. The market never goes up forever. Okay, never does. And conversely, it never goes down forever. It never goes to zero. So yes, it is scary to buy in when the market's dropping, but you never know when the bottom's going to be, just like we don't know when the top's going to be. So the thing you want to do is to rebalance and to change your allocation based on what you see with interest rates and other things, and to always have, you know, enough conservative assets available to fund your income, because most of our clients are not going back to work. Most of our clients are retired, and the number one name of the game is to make sure I've got enough money on a monthly basis to run the show as long as I live, and that could be a long time. So that's where we're coming from. I hope you can appreciate that, because I think most of our clients do. So the things for you to do is don't stress out. I send those letters out. I spend a good bit of time and research on them, and I don't lie to you. I'm being truthful. So if you know, if you want falsity, then go somewhere else. But I do try to paint it in the way that I see it. Don't stress out, avoid the news. I was telling the group yesterday that I used to be a disc jockey, and one of the things that my boss used to scorn me about, chastise me about, was whenever I gave good news. I mean, he doesn't want me to say good news. He wants me to talk about bad news, because bad news, viewers and listeners are 4 times more likely, 3.8 times more likely to tune back in for bad news than they are good news. So that's why it's built that way. And you're just going to have a bunch of bad news, and it's going to stress you out and rise your blood pressure. You don't need that. But life changes do occur. So when they do occur, just keep us in the loop, especially on the legal end. If you have a change to your heirs, or maybe some of your beneficiaries, or maybe your medical committee changes, that's one of the things that we want to talk about, is the legal and the financial documents, to make sure those are up to place. And then, of course, any concerns that you have regarding investments, that's one thing we're always willing to hear. I think everybody agrees with us that right now is a good time to be conservative and be ready to buy when the market does drop, just to see how far interest rates get before that occurs. I honestly don't think we're going to make it to 3%. If they continue to raise rates to 4%, then we're gonna be out even more. But I think probably before 3%, we'll see that, and we may be there by the end of the year, based on what the tone that I'm and the tenor that I hear from the Fed minutes. So things for us to do, obviously, are to keep you informed. Regular communication. I think we do the pretty good job on that. I mean, when market drops, I don't get any calls. No one gets upset. They all say, hey, we saw it coming. You've been telling us, and I'm pretty proud of that, to be honest with you. I'm really happy with our clientele. I mean, we think of them as a real big family, and we're treating everybody just like we treat our family, probably better. Manage your investments according to personalized strategy. Everybody's personalized. We're looking at the same types of investments, but everybody's very personalized. And if you're nervous, we want to know about it. If you feel like you're missing out and you have the fear of missing out, we want to talk about that too. But you are the boss, and we'll do what you say. But it's just important that we're in cahoots, as my uncle used to say. And then, of course, we need to stay on top of changes. And one of the biggest changes there is the Fed strategy and what they're planning on doing. So I didn't get a chance to say this, but if anybody has any questions, there should be a Q&A button. If you scroll down to, I believe it's the bottom, could be up at the top, wherever your control bar is. If there's a Q&A set there. If you have any questions, I'll stick around. I'm happy to answer any. And if I could be of any help to any of you, please send me your email or shoot me an email. Of course, you can give us a call. But it's been great talking to you. It's only took me, 34 minutes to go through that. Yesterday, it took almost an hour. And we do miss seeing you in person. So if you get an opportunity to come to the next one in person, we'd love to see you. If you have any questions, please shoot me an email. Otherwise, I'm going to let you go for the day, and it's lunchtime. So I hope everyone